First of all, good morning. For us, the key concern all of this year, the key indicators we're watching are any signs of inflation coming down. So that was by far the most important thing to look. And we began to see some signs of inflation normalizing. And here we go again, another kind of another problem thrown at the market. So it just doesn't go away. So we have strong labor market, we have consumer who can spend, and now oil prices are coming up. So yeah, no, it's increasingly challenging for central bank.
Good morning. So where is the vulnerability in the market from this? If the fact that, inflation is not under control yet, this is another dynamic to kind of fuel that impulse. Where's the biggest vulnerability?
For us, since the beginning of the year, it's been that, you have this kind of bond markets price recession, stock markets not. Stock markets trading at average valuation and expect earnings to just dip a little bit and carry higher. So for me, equities is really at risk because I personally think that inflation fighting is not over. The Fed needs to be aggressive, Fed needs to keep policy tight, and that will create earnings. And until we have this repricing of earnings expectation, that stocks are really, really at risk for, in our view.
And you're sounding like Mike Wilson over at Morgan Stanley, Maria, who, it's a day that ends in a Y, so he's got another bearish note out. And in this one, he's saying that the new bull market hasn't begun, and he's also calling out tech's outperformance, saying this aura, basically this dynamic where people think tech is more safe. It'll be buoyed by central banks cutting. It's not the case. How worried are you about tech when we see it re-enter a new bull market, really lead the past 2 quarters of gains in this equity market?
I generally agree with Morgan Stanley strategist talking about weaker equity market, but we're not constructive on tech. For us, the theme for last year was that multiple compression, and that broadly killed tech. This year, we're looking that it won't be about multiples. It's about if market goes into recession, then it's about earnings contraction. And we're really looking for sectors and styles and companies where earnings can be a little bit better protected. And the big thing for us is that we're going for outperformance of growth relative to value. We see that value stocks are a lot more vulnerable. So I'm not positive on stocks in general, but if I have to pick, I would pick growth over value because value is more vulnerable. And within growth, of course, the tech stock that should lead.
Does that mean that the outperformance of the FTSE over the past year or so, or past few months in particular, is kind of done? Because that's much more the value play there. And if you think it's back into growth versus value, does this mean that we're having another false dawn for the idea that the UK stocks can have a good era?
Yeah, I'm quite skeptical on UK stocks, quite skeptical on European stocks. So it's really how can you protect the earnings this year? So it's prefer US to Europe, both UK and Europe.
Maria, I know you're never a big fan of the banking sector, but US banks got beaten up a lot more than that of Europe. Do you think that's warranted? Do you think European banks need to catch down, if you will, to what happened in the US?
Actually, so we're never big fans of banks, but I think US banks can potentially see further derating. And the reason for us to think that is that US banks have been trading at a premium to European banks because they had lighter regulations and that allowed US banks to generate more growth. So return on equity in US banks has been substantially higher than European banks for over a decade as European banks had more regulation. And that was a key reason why US banks were trading at a higher multiple than European banks, right? So US banks, just kind of very, very simple averages, pretty much every bank traded above price to book, and Europe pretty much everyone traded below price to book. And what I suspect will happen in the US is that the price of kind of federal support, let's call it that, was guaranteeing of deposits would be much more stringent oversight. And if that does happen, then medium-long-term profitability of US banks will suffer, and that will become much more safer but slower growth. And then we'll get kind of repricing, and multiples will come down to reflect it. So more downside for US banks.
I was about to say, so more downside for US banks, but I want to finish on a positive note. I know you are bullish on some EM, and I'm curious, which EM market do you think offers the most potential for the rest of 2023?
I mean, it would probably, yes, thank Mark for finding something positive. Yeah, EM looks for us kind of a safer haven. It's removed from banking crisis, but more interestingly is that, I mean, it will sound a bit of a cliche, but like China, it has last year looked almost uninvestable, right? So we had a very stringent reaction to COVID. We had prior to that very, very strict regulation on any large company, and lots of investors were kind of exiting market. China is reopening. We had almost 6 months of kind of this conversation, but institutional investor holdings are still extremely low in Chinese stocks, and people are buying. It's not a kind of immediate kind of next couple of weeks trade. It's something that will continue for a long time. Investors kind of get reacquainted with Chinese markets, and they're coming back. So we see a lot of kind of long-term potential there.
Oh, Mark, Maria, thank you so much for ending on a positive note. I think we all needed that this Monday morning. Maria Vaitmana, thanks for joining us, Senior Multi-Asset Strategist at State Street. Coming up, Tesla deliveries hit a record, but the automaker misses CEO Elon Musk's goal. More on that for you next on Bloomberg.